So I'm sure many of you guys have had those trades where price hits your stop loss aggressively and then it just reverses, or you see these massive spikes and reversals in the market. And let me tell you, this is not random at all, guys. This is liquidity. Welcome back, guys, to another video. Like promised, if you watched my previous video, if you haven't, make sure you go watch it. I break down 2 of my trades and how I use liquidity to enter these trades. But I did mention that I'm going to do an entire video on liquidity, and that is this video. So what I'm going to do, I'm going to break down what liquidity actually is, why markets hunt these liquidity areas, and how you can implement it in your trading to take it to the next level. So my aim is by the end of the video to help you guys understand why price moves where it does, why your stops keep getting hit, and how understanding liquidity can actually change your trading level, and how to stop being liquidity and start trading after liquidity has been used. Now, let's start from the basics. So the raw definition of liquidity, forget trading, what even is liquidity? No, it's not water or like some liquid substance. Liquidity in the financial terms is basically, it's the ability to buy or sell quickly without causing major price movements. For example, look at a marketplace. If there is a lot of buyers and a lot of sellers in these marketplaces, right, these transactions happen so easily. However, if there wasn't a good balance between the buyers and the sellers at this marketplace, price has to move aggressively to find them. So what exactly is liquidity in trading? And to answer that question for you guys, it is essentially resting orders in the market. Passive orders where you find limit orders, all right? For example, you've got your stop losses, your buy stops, sell stop. People who are exiting trades, right? Because they see this area as a point of invalidation or also a point to get out of the market where they're in profit. And then you also have breakout traders, right? They look for a break of structure and price, and that's where they enter the market. So you have all these areas where there's resting orders in the market. And we'll get more into depth of why that's actually important. Now, it's essential to also know that in these markets, every buyer needs to have a seller, okay? You can't just buy randomly without someone selling it to you. That just makes no sense, even in the real world, right? How are you going to buy a phone if no one is selling you that phone, right? So in the market, if you want to buy, let's say 1 Bitcoin, someone needs to be selling you that 1 Bitcoin. So now understanding that in these markets, we are not the only people trading it, right? You have institutional banks, you have large players, right? These large players have massive amount of money and capital that they trade with, right? And when they want to fill an order, they have huge orders compared to us, where we have these tiny orders. Theirs are huge, and they need to fill these orders, right? In order to fill these orders, they need to move to areas where there is a lot of orders resting, hence a lot of liquidity, right? Does it starting to slowly make sense? So in order for them to fill these big sizes, they need to move to areas in the market where there is enough orders, enough liquidity to fill their orders, right? Because they need someone else on the other side of their trade. For example, if they are buying, they need to find someone who is selling at a particular point. But why is that important, right? Why can't they just buy it at market order straight away where price is? And that's something important to remember as well. These institutions, they can't just buy it and sell it like us at any price they want to, because this will essentially cause price to move in big imbalances, right? That's where you see these big candles with big imbalances. Some of you like to call it fair value gaps, right? That's what you see is when there isn't enough liquidity, you get these major spikes in price, right? And this could essentially mean that price is moving against these big institutional banks at a big scale, which they don't want, right? Sometimes it's better to fill all your orders in at one level, at one price, where it's either premium or discounted, and then you want price to move, right? It wouldn't make sense to say, let's buy right away, but then price is moving up and your entries is just all over the place and you've made no profit. That just makes no sense, right? So they need to move to these areas of liquidity where they can fill up their orders and not move price aggressively, right? And if we come back, what was the definition that I said at the beginning of the video, right? Liquidity is the ability to buy or sell without price moving aggressively. Just remember that. Why is it that it's always a swing high or a swing low that gets targeted That is because that's where literally a lot of liquidity is. And I guarantee you, a lot of you are placing your stop losses there. So if you're trading these area of interest, placing limit orders, right, I'm sure you guys are keeping your stop losses either above those swing highs or above those swing lows, right? And for some of you, it might not be important, right? Because maybe you're trading prop firms and your orders aren't essentially actually in the market, or some of you are B-book traders. So your trades aren't actually going into the live market, but there are people who actually are trading in the market. And even though maybe you're not in the market and your trade is actually not liquidity, you got to also think of their trades that other retail traders take, right? Because they're still liquidity. How they trade as well is going to affect the market. How other people are going to trade as well will definitely affect the market. You got to keep that in mind, right? Not just how you trade, but how other people trade. Okay, so like I said, liquidity is most likely to stack up in these places where everyone, a lot of people, because remember, we're all human at the end of the day. A lot of people trade very similar in terms of risk management, stop loss placement. There's obvious places where these liquidity stack up. There's these liquidity pools at equal highs, equal lows, swing highs, swing lows, daily highs, daily lows, right? These are not magical level, guys. They're not magical levels, right? It's just where liquidity is sitting, where we're all human. We place these trades and have very, very similar stop loss placements. Now, if wrapping that all up, right, it's going to sound the same, but I'm just joining all the pieces together. So price moves to where this liquidity is resting. And it's important to understand, look, they're not targeting you. Big institutions, banks, large players, they are not targeting you. Let me ask you this. Do you think they really care what old Ryan is doing in his house on a 6 p.m. and they're like, oh my gosh, let me go target this guy's stop loss and like his life? No, they do not give a shit. What they give a shit about is filling their orders to make profit. That is what they're doing. They're just wanting to fill up their orders. They're not there to target you. They're not there to hunt you. Yes, I've had that time as well where it's like, these guys are purposely against me. But look, in reality, they're just not. And we got to come to terms with that. So that's where it comes in, understanding that they're not targeting you, but they're targeting these liquidity pools, and we can actually use that in our advantage, right? As another trade confluence to entering the market or seeing price continuation. It's also important to understand, just because liquidity is being taken does not mean price is going to go a certain direction. Liquidity is fuel. Liquidity is fuel, guys. Liquidity is not price movement. Don't get those two confused, right? Because these guys are filling up orders, right? Essentially filling up their car with fuel, and then they decide where they want to go. They're just filling up their orders, right? They're either selling or they're buying. That is the main important key. It's not price direction, it's fuel. Liquidity is fuel for the market, and then you get these big moves. This is where you guys see the lot of ranges happening, right? These ranges that are happening, it's indecisiveness between buyers and sellers, right? There's a balance between, this is where you see the balance between the buyers and sellers, right? They are slowly stacking up their orders, right? The buyers and sellers agreeing on a price. They're just buying and selling at this point. There's not much movement, right? But as soon as you see an imbalance between a buyer or a seller, and let me say this as well. This is where liquidity runs dry. Once liquidity is run dry, this is where you see these massive candle push-ups in price. Look, I'm going to show you on the charts as well, so don't go away, guys, because me going on the charts and showing you will give you much more in-depth explanation. But I'm just going to quickly go through all the information. Make sure you guys are getting this information. It is important. It's actually going to change how you see trading. But when liquidity runs dry, this is when you see these great pushes in price. Because when they don't have enough orders to fill at this particular point, this is what pushes price to continue, because they need to find liquidity, right? They need to find orders to fill their own orders. That's what causes these aggressive push-ups in price, okay? Now, if I explain this, let's say this guy has 50 orders he wants to buy, right? You have at a particular point level here, right? They are selling only 5 orders at this point, and then later below, then there's 40 orders, and then later below there's 5, right? In order for this guy, if he clicks market order, enter, right? For his orders to be filled straight away, he needs to go find where these people are selling these orders. And as you can see, it's at this 5 range, 40 range below, and then this other 5 range below, which adds up to 50. So this is what caused this aggressive push down in price, because they needed to push price to this level to fill his orders. That is the imbalance between buyers and sellers, because they're not at the specific zone having a balance between buying and selling at a particular price. Price had to push aggressively to fill these orders. All right, so let's jump onto the charts, guys, and let's get you a better understanding of what price actually looks like. All right, so let's do this. Orem, Bitcoin, and look, this works for all different markets. Liquidity is in every single market. Yes, it's there. You just need to learn how it's different for each market, how each market moves based off liquidity, which comes with experience, which comes with time. But I'm telling you, it is a game changer to understand liquidity, because it is the fuel of the market. This is what makes the markets essentially move. It doesn't give you direction, it just gives you the fuel for the movement, all right? But look, all of these wicks are literally liquidity being taken, right? Essentially, it's not always wicks. Sometimes it's as well candle closes and then reclaims. You have trap and reclaims, plenty of them. But look, all of these candles, liquidity sweep, liquidity sweep, liquidity sweep, right? Let's jump onto the 4 hour. You get a better understanding of these liquidity sweeps, right? Look at this. Boom. Straight away. Liquidity taken here. Look. Liquidity taken here. Look. Liquidity taken here. Oh, it's everywhere, bro. Look. Liquidity taken here. Dude, it's everywhere. I'm telling you, this, I can't make it up. It's everywhere. Liquidity is everywhere on these markets, right? This is one sign of liquidity being taken. Right? You have these massive push downs and then a reclaim of price. All right, look, let's jump on this little cluster of price and look at this. This also took out liquidity from here, right? It doesn't have to be right next to each other. It can be from a while back, right? Because you got to think, people are stacking orders here. It's a major zone. It's a major, like you go on the daily, look at that. Look at that. Imagine the amount of people stacking up shorts. They're seeing this as a supply zone, right? Price push down, broke this structure here, right? You've got this zone here, right? This little supply, you've got this massive supply zone here. People putting their orders in, stacking their stop losses, or people wanting to go long. You got breakout orders there. Like, can you see how it ties up and makes sense, right? You got liquidity there. Now let's jump onto this pocket of price, okay? Look at this. We had this, I've marked out, that was that major swing high before, right? And as you can see, price has swept it aggressively and it's closed below. Let's go to the 30 minute, give you a better understanding, right? Price has taken liquidity, right? Markets fill these orders that it's needed, and then you have this massive push down, push down, push down, push down price, right? People are looking to buy at this level, right? So let's dive into the quick dynamics of here. If I had an order here, wanting to go short, I put my stop loss above here, right? So I'm looking to sell at this level, right? Let's say I sold here. And if I wanted to exit this trade, right, I need to buy back my position. So I've sold it first, and for me to get out of this trade, I need to buy it back. You can't sell something that you're selling, right? That just makes no sense, right? You need to buy it back in the market. That's how it works, right? So you have a lot of buy orders here. A lot of buy orders, okay? Say these markets wanted to go short. They need to sell. They need a lot of orders to sell at this level. For them to sell, they need someone who is buying orders, right? They need someone on the opposite side. They're selling, someone needs to be buying, right? Imagine the amount of orders stacked up at this level because of this swing high here. People are going to go short. These banks, these institutions needed somewhere where liquidity is lying, where there's so many orders to fill their order in. They push up, get these orders. Once it's enough orders, they've pushed down and pushed price down with them, right? That's what liquidity is, resting orders in the market, right? And there's two different types of liquidity, right? Let me go back to the 4 hour, right? So there is buy side liquidity and sell side liquidity. It's pretty obvious, right? Sell side is going to be resting below like this. So this is sell side here, right? Let me mark that out. Sell side, and then you also have your buy side liquidity, right? What the? So you have your buy side liquidity as well. I'll mark that out for you. So buy side obviously is sitting above, right? Because people looking to buy at that level. And then you have your sell side, people looking to sell at that level. A lot of sell orders, a lot of buy orders, right? That's what it is. You can see price moves. Price moves from buy side to sell side, right? It moves within that range. It doesn't necessarily always have to respect it. Just remember, it's fuel. It's not direction. Just because we've got look at this. Just because we got a sweep here, doesn't mean price necessarily has to dump all the way down. No, it's fuel, right? It's not direction. Like I keep addressing, it's fuel, not direction. Remember that, guys. Okay, and I'll go more into depth as well of understanding how it always doesn't work. So look, we've had that sweep, reclaim, but it wasn't strong, okay? We had a little push down, but it wasn't strong. Price wanted to keep pushing up, right? And this is why you solely can't rely on liquidity. Liquidity is a confluence among many other that you'll use. It's a strong confluence. It gives you more of an understanding of where the markets are moving towards, right? Because you got to think about it. Yeah. Let's say if you've taken out liquidity here, you're essentially wanting to look. Wait, sorry. Let me mark this out for you so you get better understanding. All right. So let's say you've taken out this liquidity here, right? You've taken out liquidity here, and you enter a trade. How can I look for where to get out of the trade next, right? And this is also where liquidity can work in your favor, right? Somewhere to target, where price wants to target to get liquidity for more fuel for price to move. So you can use these areas, right? You've got liquidity here, for example, right? Look at this. That's liquidity, right? People are stacking up orders over there. Like if you go into the 1 hour, right, look at this. You've got this bearish leg, right? People are going to be putting their orders there. Let's say we go long here, stop loss under here, target this liquidity, and boom. Price takes out the liquidity, guys. Like, it works in both ways, right? It can be somewhere to look for an entry and also somewhere to look to get out as well for trade, right? Even vice versa, your stop loss, your take profit, it all works like that. It's just understanding the dynamics of what liquidity is, why these markets move to liquidity to fill orders, okay? Now, something important as well to remember, the more aggressive spikes, right? As you can see, there's not always these big spikes, all right? Let me, for example, look at this, for example. You've got this. Look at this candle. Look at this wick size. You've got this huge wick of liquidity being taken compared to like at this level here, right? You've got this little wick, right? So these two wicks are completely different in size. And the reason being is because at this level, there was enough orders to be filled. That price didn't even have to move higher to fill all of these orders, right? There was enough liquidity at this level to push price down. However, at this level, there wasn't enough liquidity at just this level. They needed to target more liquidity at this level, right? And as you can see, they swept this level as well, and then pushed price down, came back for a little retrace and dumped, right? So there's two different types of wicks. There's a really big wick and there's a really tiny wick, right? Now, a beginner mistake that a lot of traders think is that every sweep means a reversal, and this is definitely not true. And I've shown you here, we've had this sweep here. We did not have a reversal. Price did not push down, it kept pushing up, right? For example, another place here as well, right? We've had a sweep here, but price didn't move up, right? There was a lot of accumulation of orders here, which then pushed price higher. And this comes back again to the same thing. Liquidity is fuel. It is not direction, guys. So stop thinking that every sweep needs to turn and go. Sometimes liquidity just being taken out to continue in the same direction, okay? It's just filling up orders. That's all it's doing. That is what liquidity is. So guys, in a nutshell, that is what liquidity is, and I'll quickly sum it up for you guys. So what is liquidity? Liquidity is resting orders in the market, right? Remember, these markets, they are not hunting your stop loss, they are hunting liquidity, resting orders, right? And regardless if you are trading live and your orders actually go to the market or not, doesn't matter. The market still moves to liquidity. So it's time to start thinking how you can lose liquidity in your favor rather than being the liquidity guy. Number two, and not every trade, guys, has to reverse off a liquidity sweep, right? Liquidity is just fuel for the market. I've said this probably 1,000 times this video. I know you're sick of hearing it, but liquidity is fuel. It is not direction. Use liquidity as a way to see where the market could possibly move to. It gives you an understanding of where the markets could potentially move to fill these liquidity, fill these orders, right? And look, you can't just trade off a liquidity sweep only. It does not work. Tying liquidity in with other key important concepts in the market like supply and demand, which I will be making a video, guys. Make sure you are subscribed, you leave a like and a comment, because that supply and demand video will come out. And if you did enjoy understanding more about liquidity, underlying dynamics of liquidity, and if you feel like this could actually change your trading, then just imagine what that supply and demand video could do, because supply and demand is also very big. It is a key concept in the markets of any economic markets you're in. Supply and demand is huge. That's what also moves prices. Liquidity, supply and demand, right? That's what I'm trying to emphasize. You can't just use liquidity to take trades. You need a confluence of key market concepts that allow you to gain possible outcomes of where the market could move to, guys. So I hope you guys actually learned something in this video. And if you did, please make sure you subscribe, leave a like. There'll be plenty more videos to come. Peace out, guys.